Well, I mean, the degree to which it's actually stimulating the real economy is up for debate, but the Fed has enormous scope to do more, particularly in the corporate bond market, given, the size of the QE program with corporate bond purchases has been really small relative to the overall size of the corporate bond market in the US. And if you compare to other QE programs around the world, the Fed's done relatively little. So if they really wanted to make a splash in the corporate bond market, there's plenty of scope for them to do that. But given where spreads are, frankly, they've had an impact just by doing a little bit and talking a lot. I guess the issue is if the Fed does too much in the corporate bond market, you risk having pockets of illiquidity where the market just isn't able to trade freely because the Fed is basically, taking all the supply and free float out of the market. We're nowhere near that yet, but there's scope to provide support if needed.
April, just putting this all together, is it fair to say that we're going to see most of the election reaction on the equity market and also in foreign exchange markets, not necessarily on the bond markets as we waited up for the Fed later on?
Yeah, I think so. I think the bond markets are just going to sit tight and see ultimately, what the results are. I think, the equity market and risk markets generally have been kind of up and down depending on how the polling looks. We do think we're just going to sit and wait and see. And even so, I mean, almost regardless of how this pans out, what the markets would like to see is just to know the final result, which, as we all know, could take some time, given the amount of mail-in voting that has to occur. But ultimately, the Fed has got our back. We assume that Fed policy will remain unchanged under really either leadership structure, and QE is also there as a stabilizing force. So this period of financial repression essentially is here to stay and is likely to be a stabilizing force.